Investors happy with Nvidia's third quarter results. We did see the chip giant shares trending higher ahead of the bell. Revenue in the latest quarter stronger than expected, easing concerns for some about an AI bubble. Let's bring in Gil Luria, head of technology research at DA Davidson. Thanks very much indeed for joining us. What jumped out for you, please, in the latest quarter?
So not only were their results great, they're still exceeding expectations in spite of the fact that the numbers are now out of this world. They exceeded expectations for next quarter. Next quarter, they're going to do $65 billion of revenue. This is a company that was doing that much in a year just a couple of years ago. So that's impressive in itself. But what's a lot more important is that the company followed through on longer-term guidance, on saying that they're going to sell $500 billion of the Blackwell and Rubin families between this year and next year. This is the first time, the last couple of weeks have been the first time they've provided long-term guidance since the AI cycle started. So that tells us that they're more confident now than they've been over the last couple of years. And that's saying something, especially since that number is a lot higher than we expected. We're now talking about them growing to over $300 billion of revenue next year from something closer to $200 billion this year. That's the incremental $100 billion of revenue is absolutely staggering. And they really provided guidance for that for the first time.
So just give us that again. They're talking about next year, potentially revenue hitting $1/3 trillion, up from $200 billion this year.
That's right. That's right. It's unprecedented rate. No company has ever added that much revenue in a year. No other company's ever added as much revenue as they're adding this year ever. And then the number they're going to add next year is even more. And it's at a very high profitable level. They're doing this at mid-70s gross margins, and they can't spend money fast enough for that not to go to the bottom line. So they're generating tremendous amounts of cash flow, which they're still using to buy back stock. The stock isn't even expensive. It's now, because we raised our numbers so much, it's trading at 27 times next year's earnings. To put that in perspective, that makes them the least expensive part of the AI trade. Nvidia, which captures most of the profits, almost all of the profits at this point from AI, is trading at the lowest multiple of any of the parts of the AI trade.
The Wall Street Journal says today that the law of large numbers hasn't seemed to catch up to Nvidia yet with this frenetic growth.
Yeah, and I think people have been waiting for it to kick in, and clearly it is not. And we have to just think about why that is. The big picture is that the models are so potent, they're so powerful already as they exist, that there's so much consumer usage and growth in consumer usage, but more importantly, the business demand for AI compute capacity is growing so fast that it's telling the key providers, which are Amazon, Google, and Microsoft, that they need to buy as many GPUs as they can. Every data center they're building right now is already committed for 3 years out. And that's because the models are so potent and powerful that their business customers are telling them, we think this is going to be such a productivity enhancer for us that we're willing to commit 3 years out for this capacity. The market isn't just the market for enterprise technology. The customers for Amazon, Microsoft, and Google that are buying this capacity believe that it will be a labor replacement. And that's why we're talking about these kinds of magnitudes. We start talking about trillions of dollars because we're not just replacing parts of the technology stack, the enterprise software stack. We're starting to talk about how this is going to impact the labor market, which is obviously in the tens of trillions. So that's how we got to these very large numbers, and that's why we're still growing these very large numbers.
Just the Journal again says Nvidia is developing an enviable problem. So much cash coming in. The Journal says this is draining the cash flow of big tech because they're spending so heavily. But annual cash flow for Nvidia has now topped $80 billion.
Yeah. So two things. One is they're taking the oxygen out of the room. It's not, they're growing the pie, but they're taking increasingly large parts of the pie, right? The cash flow for their customers is diminishing, and for their customers, it's diminishing as well. It's a lot of Nvidia sucking the oxygen out of the room. Now, what do they do with that cash? Again, some of it they're going to buy back stock, but they also have an opportunity to invest in the ecosystem. That's what we saw with their announcement about an investment in Anthropic. They're already investing in OpenAI. Mm-hmm. They're investing in neo clouds, which are companies that are there to compete with their core customers. They just have too much cash. They run out of things to do with it.
The journal, sorry, I keep going back to them, but they have been beating the drum that OpenAI and Anthropic need to produce massive cash flow themselves to support their own ambitious spending plans. Could that be a weak point in this whole circus, that these actual providers of AI technology aren't getting in enough cash to support their spending?
Yeah, so OpenAI and Anthropic themselves are driving a lot of the demand, but they're not necessary. The frontier model at Google is just as good or better at many of the things that OpenAI and Anthropic do. And if OpenAI and Anthropic can't raise capital fast enough, the frontier models will just be frontier models from Google and Microsoft and Meta and Amazon. Right now, OpenAI has the lead in chat. They have most of that market. Anthropic has the lead in enterprise coding models, which is why it makes sense for those big companies to continue to invest in them, which is what we're seeing. Microsoft and Amazon are continuing to invest in OpenAI and Anthropic. It's still worth it for them. Now, OpenAI and Anthropic are both losing tremendous amounts of money, especially OpenAI. Mm-hmm. But part of that is because OpenAI's scope is way, way too ambitious. OpenAI, at some point, will need to focus on what they're really good at, which is ChatGPT, and stop trying to become another mega cap by building their own chips and their own hardware and their own data centers. They don't have the capital to do that. They've caused a lot of the noise in the market. The reason there's been such a backlash around the AI trade is that OpenAI created unreasonable expectations from their commitments. They inflated some asset prices, including those of Oracle and CoreWeave and AMD and Broadcom. And as it became clear that OpenAI can't live up to all those expectations, many of those stocks got deflated. That's the reaction we've seen over the last few weeks. But realistically speaking, we don't need OpenAI for the AI ecosystem anymore. They had that big breakthrough with ChatGPT. They still have the biggest part of the chat market. Mm-hmm. But even if OpenAI was to go away tomorrow, we would still continue to move along the frontier of AI models.
Gil, always great talking to you. Thank you very much indeed.
Thank you.
Gil Luria, Head of Technology Research at D.A. Davidson.